For more, we're joined by Raymond James chief economist Scott Brown. He's a Bloomberg best for his accurate calls on unemployment. And also, of course, Ralph Schlosstein still stays with us from Evercore. And I'm just looking through my notes here, Scott. You had expected basically the jobless rate to come to 9.6%. So this is the surprise here, right, Scott?
I think it is a big surprise. I didn't see what the labor force participation was. That may have been a key part of the story. The household numbers do tend to bounce around a lot. They're not really reported all that accurately. So it's not unusual to see it bounce around. It could be the case that many people have had their unemployment benefits expire. I mean, even with the extension of unemployment benefits, you're still limited to 99 weeks. So you could have a number of people still rolling off the labor force totals.
Well, definitely. I mean, I think that there is some of those factors in there. I'm looking through the table right now. But as we're going through those numbers, though, Scott, for Ralph, for you, what is your reaction here? What does this tell you?
Well, I think probably the first thing it tells you is that to focus on any 1 month, even though we always do, is probably too finely honed. And what we should be looking at is the rolling 3 and 6 month trends, which are generally more employment, declining unemployment, and more activity. I mean, this week alone, we saw ISM services at a 5 or 6 year high, ISM manufacturing at a 5 or 6 year high, ADP higher than expected, jobless claims lower than expected. This is a particularly,
part of the story, yes.
Yeah, I think this is a particularly, to coin a not economic term, bouncing around type series. So 1 month, I think it's difficult to tell.
Right. Mike, I want to get to you because give us a better picture about that labor force participation and about this jobless rate.
Well, jobless rate at this point is a good news story. And if you go back in previous years, occasionally this has happened where we start to see the numbers get better as we go along. But when you look at the numbers today, the labor force falls by 504,000. So that is really the reason that we see unemployment fall. But the question is, was that because people didn't want to work, they were discouraged, or because they couldn't get to work? 707,000 people were unable to get to work. That's why we saw such a bad number on the establishment side. So it's really a weather story today. And until we can back that out, maybe the February numbers, we're not going to really know what the participation story is or what the real strength of the labor force is.
Okay, so even backing that out, I know that we've got to add that in because that is a factor here. Scott, what does this tell you then about where the jobs market is headed?
Well, I don't think it tells us much at all where we are right now. I think if you look over the course of last year, we saw a very low rate of job destruction. If you look at announced corporate layoff intentions, they were the lowest total last year since 1997. The January figure that we just got earlier this week was the lowest January total on record. These are the challenger layoffs. And they go back to the early 90s. The real issue for the labor market has been a lack of job creation. I think that's going to come over time, but I don't think we should be surprised that the labor market is going to lag in this recovery. I mean, this was a very, very severe recession, if not a mild depression, and it's really going to take a long time before we get back to normal.
Betty, I want to give you an update on what's happening in the bond market. We told you that in the stock market, investors resumed course and started buying stocks. They resumed course in the bond market by selling bonds, and that continued to push up the yield on 10-year treasuries. In fact, we briefly saw the 10-year yield at its highest level since May, almost 3.6%. Remember that if you go back to the fall, Treasury yields for the 10-year were below 2.5%. The momentum has been with stocks. It has not been with the bond market. And a lot of traders ahead of this decision were saying, I'm not convinced that it's going to be a bond market number, a number that says the economy is falling short. And while today you've got all these headlines coming in, they're still trying to figure out what exactly this means, because as Mike was mentioning, you've got a lot of construction jobs and temporary jobs that seem to be absent, and that certainly would suggest that the weather story played a huge role in this number.
Yeah, this is clearly not a clean this is not a clean data point for the market. Essentially, that's what you're seeing reflected. Ralph, Scott made a good point about how we're just not seeing job creation, strong job creation. In your view, what is the problem here? Why are we not creating more jobs?
I think that every job that's created flows directly through the income statement of a corporation and therefore, as expense, reduces profitability. So if you can't get, so some of our very strong profit growth over the last couple of years has come from a relatively tepid top line growth and very, very tight expense management. And what I expect to see at some point is, companies can only hold off so long. They hire temporary workers, they do overtime because they're not confident about the pace of recovery and the reality of recovery. And at some point, I would expect to see some catch up in job creation versus output, because job creation has really lagged output. Now, some of that is productivity, which is still doing extremely well. Right. But at some point, you just can't hold off, and you hire.
Let me just pick up on where what Mike was talking about, which is that average weekly hours worked going up 0.4%, because that's kind of what Ralph Schlosstein was talking about, which is that eventually jobs is going to outpace the output that we're seeing in the economy. Eventually, we're going to see a turnaround. Do you think that this number, even with the snow factor, indicates that, Scott?
I think so, particularly in the manufacturing sector. One of the stories that came out of the fourth quarter GDP numbers is that inventories were a lot leaner than anticipated. So it looks like not only did we have an inventory correction, but we may have had an inventory overcorrection. And you see that also reflected in the lower imports, that as many firms hold inventories overseas. So that implies better production in the near term. So it's not surprising, I think, to see the manufacturing numbers pick up. And I think more importantly, you look at what's the outlook for the consumer in the current quarter. Well, we just had a huge cut in payroll taxes. And that's going to really boost disposable income. So that should keep consumer spending growth going forward. You saw a drop in the savings rate, which may indicate that consumers are more optimistic about the outlook. And hiring is going to lag in a recovery, and we expect to see the hiring pick up. Firms are still very reluctant. They're still watching costs. Small firms are still credit constrained. But firms large and small, I mean, they're not going to really start hiring until they see an increase in demand for the goods and services they produce. And I think we're going to get that over the next several months.
Now, we know all of this, the weather for January. I mean, is any of this, though, going to delay that hiring that you're talking about through 2011?
Perhaps so, and we may show up in February. But when you look at the unadjusted numbers, you normally see a huge drop in January. So you need to take the January numbers with a grain of salt. More importantly, we're going to see very strong job growth on a seasonally unadjusted basis in March, April, May, June. That tends to be the time when a lot of firms are going to start their new hiring. And we expect to see a pretty good spring this year, and probably above trend job growth. But again, not a whole lot compared to what we need at this point. We need to really see GDP growth 5 or 6%. Right. We may get 3.5 or 4%. Right.